It's Thursday, February the 25th, and we are going to embark upon one of the more exciting conversations known to the financial world.
Put your seatbelts on. Just put
This
them
is
on.
riveting.
Tie it down.
10-year treasuries.
Yes.
Woof. I know, folks. I know it's crazy.
You've been waiting for it. You've been looking for it.
Here it
you
comes.
wanted it. This morning, what was most interesting, see, it even knocked off something, right, in the studio.
It's knocking stuff out of the chairs.
What we observed this morning and we observed this week, this morning was fascinating. Thursday mornings early, we get up, Giv and I both get up early risers anyway, but we get up and prep for latest information.
Not together. But
No.
Separate
places in our own homes. We get up and we begin to get current information, just the latest stuff to bring to the radio shows and to the video here. This morning's 10-year treasury, when we began to look at it, was at 1.42, 1.43. And 30 minutes later, it was 1.45, and then it was 1.46, and it was moving. And then you had an observation in the last.
I went back 2 weeks because we talked about this 2 weeks ago on air, and it was at 1.15. So in the bond world, when you see a 30 basis point, 0.30 increase in a very short period of time, it's almost like the Dow going up 1,000 points. So the question would be, why is this happening?
And the answer to it is not because of what the Federal Reserve is doing, because Jerome Powell had a meeting in the last 2 days, and he reiterated and doubled down again on the fact that the Fed is going to continue its stimulus. It's not going to stop its QE buying of bonds, and it has no intention to do something intentionally to raise interest rates.
Right. So what's happening is it's more of an organic increase, as we were seeing a little bit of inflation with, look at oil prices. I mean, I think you're paying, 30 or 50 cents more a gallon than you were a couple of weeks ago. So that's inflationary. We're seeing food costs increase somewhat. We're seeing the costs of building homes increase with lumber costs and copper costs. So we're seeing commodities, and we're seeing increases in areas that would suggest that we might be seeing some inflation.
The bond market has also been said to be a market that looks ahead, with oftentimes the stock market a market that looks in the rearview mirror. So what it also says to us is that the bond market is fully anticipating that the market itself, the economy itself, is going to pick up steam, and it's taking that position primarily because of the vaccination and the stimulus that's coming down the pipe. So the bond market is saying things are going to begin to heat up, things are going to continue to grow, things are going to speed up, do well, employment numbers, all that is going to be the bond market is anticipating growth going into this year.
So in 2020, the inflation rate was 1.4%. The Fed has steadfastly stood by that they're not going to be satisfied until they reach 2% inflation. And Jerome Powell has said they're even going to allow it to go beyond 2% before they even think about starting to raise rates. That's a long way to go before we start to see the Fed raise rates. So we at HMC Partners made some moves in anticipation of this occurring by buying a little bit more in the high yield market, and definitely into the inflation protected market, also known as floating bank rates.
We also, from an equity standpoint, we've begun to add value to portfolios. We began to add things that are cyclical, that is moving up, that moves up when the economy moves up and heats. We've added mid caps, we've added small caps, and in some instances we've even added international. So we've begun to diversify the portfolio on the equity side to take advantage of the rising interest rate, the rising 10-year, and the rising rate of observation of inflation, both on the bond side, and we feel good. Now, does it mean there's not going to be volatility? No, there's going to be volatility. But we believe that the projection is on an upward trend, and we're taking advantage of it. And we thought a 10-year Treasury note lesson would be important.
And if you're still awake, then always remember it's your money.
And your money matters. Call us anytime. We'll be glad to chat with you.